Should I change my retirement investments during a crash? Imagine waking up to a sudden drop in the stock market and wondering if you should hit pause or keep going. It's a common question for many seniors facing market downturns. Let's look at what the facts say about managing your investments during these times. First, it's important to understand that market crashes are normal parts of investing. They happen periodically and are usually followed by recoveries. The key is having a plan in place before the downturn begins. Making quick decisions based on fear can lead to selling investments at their lowest point, which often results in locking in losses. Instead, sticking to a well-thought-out strategy helps you stay calm and avoid emotional reactions. One approach many retirees use is called a bucket strategy. This involves dividing your savings into different parts based on when you'll need the money. For example, keep enough cash on hand for 1 to 2 years of expenses. Then, have a second bucket with bonds or other stable investments for the next 2 to 4 years. The rest can be invested in stocks for long-term growth. During a crash, you draw from your cash and bond buckets first, so you don't have to sell stocks at a low point. If you do need to access your investments during a downturn, try to sell from your cash reserves or fixed income investments first. Taking income from dividends or interest is better than selling stocks, especially when prices are low. If you're required to take minimum distributions from your retirement accounts, plan carefully which assets to liquidate so you don't disturb your overall strategy. Rebalancing your portfolio during a market decline can actually work in your favor. If stocks have fallen, they now make up a smaller part of your portfolio than intended. Buying more stocks at lower prices helps bring your allocation back in line and can set you up for future gains. Just be cautious not to trade too often, as this can increase costs and taxes. Market downturns also create opportunities for tax-saving moves. Selling investments that have lost value in taxable accounts can generate capital losses to offset other income. If you have traditional individual retirement accounts, a market dip might be a good time to convert some or all of it into a Roth IRA, which can save on taxes later. As a senior investor, your goal is stability and income, not aggressive growth. That means holding enough bonds and cash to weather storms. If your current setup isn't aligned with your comfort level or income needs, consider gradually adjusting your allocations through new contributions or within tax-advantaged accounts. Avoid making big changes during a crash unless your circumstances have changed significantly. Having cash reserves equal to 1 or 2 years of living expenses is your best defense. This emergency fund allows you to cover your bills without selling investments during a downturn. It's the most reliable way to protect your income and peace of mind. In the end, history shows that markets recover over time. Those who stay invested and follow a plan tend to come out ahead. Making impulsive changes during a crash can cost you dearly. Instead, stick to your predetermined strategy, focus on your long-term goals, and remember that market dips are temporary. Your portfolio should be built with this in mind, providing steady income and protection through all market conditions.